There is a particular cruelty embedded in systems that are technically fair, but practically invisible. And nowhere does that cruelty express itself more quietly, more persistently, or more expensively than in the architecture of American retirement finance. The government, in its infinite and impersonal efficiency, has constructed a series of doors. Behind each one sits money, real money. Money already earned, already taxed in some cases, already paid into a system by people who spent decades contributing to it without complaint and without condition. The doors are unlocked, the signs above them are public record, downloadable from government websites that any citizen can access at no cost. And yet, with a consistency that ought to disturb anyone who thinks seriously about the relationship between the state and the individual, millions of Americans born before 1971 walk past those doors every single year without ever knowing they were there. This is not negligence on their part. It is a design failure, or perhaps more precisely, a design choice, that we should name clearly before we explain how to correct it. Let us begin where the money begins to disappear. Every month, a pension check or an IRA distribution arrives, and before it reaches the account of a retired American, a withholding rate has already been applied to it. That rate was determined not by careful analysis of the individual's current tax situation, but by a default setting, a bureaucratic best guess that errs, as bureaucratic best guesses so reliably do, on the side of the institution rather than the individual. The form that governs this withholding is called Form W-4P. It is available at no charge at irs.gov. It is a withholding election form for pension and IRA distributions, and its significance cannot be overstated in the context of retirement income management. Here is the mathematics of what that default rate costs a person who has never challenged it. A retired man in his late 60s, living on a pension of $38,000 annually, has 10% automatically withheld. Over a year, that is $3,800 removed before the money reaches him. But when you apply the standard deduction available to filers his age, the additional deduction that activates at 65, and his actual income profile in retirement rather than the income profile the default rate was approximating, his real federal tax obligation on that pension income might be closer to $1,400. The gap between $3,800 and $1,400 is $2,400. That is $200 every single month that he is loaning, interest-free, to the federal government, and receiving back in April as a refund that feels like good news but is, in every meaningful financial sense, a record of his own money being held from him longer than it should have been. Form W-4P corrects this. You download it. You complete the withholding worksheet on the reverse side. You submit it to your pension administrator or IRA custodian. The adjustment appears not on your next tax return, but in your next distribution. The money returns to its rightful owner within a single billing cycle. This is not a loophole. This is not a benefit program. This is a correction mechanism, and the only reason it so rarely gets used is that almost no one in the chain of institutions handling retirement income has a financial incentive to tell you about it. And while we are examining the withholding question, consider what happens on the Social Security side of the ledger, because what happens there is, if anything, more consequential and more commonly misunderstood. Social Security payments, by default, arrive with zero federal income tax withheld, not reduced withholding, not minimal withholding. Zero. For some retirees, those whose combined income falls below the threshold at which Social Security becomes taxable, that default is perfectly correct and they owe nothing. But for a substantial portion of Americans born before 1971, particularly those receiving pension income or taking IRA distributions alongside their Social Security benefit, a meaningful portion of that benefit is taxable, and zero withholding on a taxable income stream is not a policy choice one should make passively. It is a time bomb set for April. The form that governs this is Form W-4V, a voluntary withholding request available through SSA.gov. It offers 4 withholding rates: 7%, 10%, 12%, or 22%. The citizen selects the rate that most closely approximates their actual tax obligation and submits the form to the Social Security Administration. Going forward, that percentage is removed from each monthly payment before it arrives, and the ambush in April is avoided. But here is the dimension of this that receives almost no attention in public discourse about retirement finance. Form W-4V works in both directions. There are seniors in this country who are significantly overwithheld on their Social Security benefits. People who elected the 22% rate years ago when their household income was substantially higher, whose current income has since dropped because they retired, completed large IRA distributions, or no longer earn wages, and who are now sending an extra 12 or 13% out of every Social Security check to Washington each month when their actual tax obligation on that income is closer to 9%. A couple, both in their early 70s, collecting a combined Social Security benefit of around $34,000 annually and still withholding at the rate appropriate for their income 5 years ago, might be over-withholding by $2,000 to $2,200 per year. That is not a rounding error. That is a monthly budget impact. A new Form W-4V filed with the SSA, updated to reflect their current situation, corrects this, and the correction flows through within 1 to 2 billing cycles. Most people who would benefit from this correction have never been told they had a choice. The form is how you exercise one. And if there is a principle that should emerge from everything said so far in this discussion, it is this. The system is not designed to return money to you proactively. It is designed to hold it until you file the specific instrument that releases it. The government does not send a representative to your door to say your withholding is running 30% above your actual obligation. Your pension administrator does not have a compliance team reviewing whether your monthly take-home should be higher. These forms exist. The pathways they open are real, but they open only from the inside, and only when the person who should be walking through them knows where to knock. If this conversation is one you have needed to have for a long time, if you have been watching a refund arrive every April and feeling grateful for money that was yours to begin with, share this with someone else who deserves to know it exists. Hit subscribe, because what comes next involves a tax return form the IRS created specifically for people in your situation, and a Medicare surcharge mechanism that may be costing you thousands of dollars right now based on income you stopped earning 2 years ago. In 2019, with the minimal fanfare that characterizes most genuinely consequential bureaucratic reforms, the Internal Revenue Service introduced Form 104-0-SR. The SR designation stands for senior, and the form was designed specifically for taxpayers who are 65 years of age or older. Its introduction did not generate headlines. It was not announced during the evening news. Most tax preparers incorporated it into their workflow without ever explaining to their clients that it existed or why it was different from the standard 104 they had been filing for decades. This is, in microcosm, the story of most of what we are discussing. The mechanism exists, the benefit is real, but the knowledge does not automatically travel to the people who need it. The dismissive reaction to Form 104-0-SR, that it is simply a regular 104 with larger print, reflects a misunderstanding of what the form actually does structurally. Yes, the typography is more legible, and that is not a trivial matter for its intended audience, but the substantive difference lies in how the form treats the deductions and income categories that apply specifically to people in the retirement stage of life. The standard deduction for taxpayers 65 and older is higher than the standard deduction available to younger filers. There is an additional deduction amount that activates at 65. For those who are 65 or older and also visually impaired, there is a further increment on top of that. These stacked deductions represent a significant reduction in taxable income, and they reduce what a retiree owes in a way that younger filers simply do not experience. The 104-0-SR places these deductions in a dedicated section that is impossible to overlook. The standard 104-0, designed to serve a population that ranges from 22-year-old first-time filers to 80-year-old retirees, does not feature them with the same prominence or clarity. The practical consequence of this organizational difference is that people filing on the standard form are more likely to miss deductions they qualify for, not because the deductions do not exist in both forms, but because the 104-0-SR is structured to surface them, and the standard 104-0 is structured to handle everything, which means it handles retirement-specific items less clearly than a form purpose-built for that population. If you use a tax preparer, the correct question to ask before signing your next return is simple and specific. Are you filing my taxes on Form 104-0-SR? If the answer is no, the follow-up is equally simple. Why not? If the explanation offered is not specific to your individual tax circumstances, a particular complexity that genuinely requires the standard form, that conversation is worth continuing. If you file your taxes through software, verify that your age has been entered correctly in your profile, because that information is typically what triggers the platform to route you to the 104-0-SR automatically. Check, before you submit, that the form used is the senior version. The principle underlying Form 104-0-SR is one that applies broadly to the entire set of forms under discussion here. The IRS created this instrument because it acknowledged institutionally that the standard form was not capturing the deductions that retirement-age taxpayers qualified for as clearly or as consistently as those taxpayers deserved. This is not a criticism the agency would phrase that way, but the creation of the form says it plainly enough. Using the 1040-SR is not gaming the system. It is using the form the system built for people in your situation. Now, we arrive at the form that requires the most careful attention because the problem it addresses has been accumulating quietly for decades in some retirement accounts, and the people it affects are often entirely unaware that anything has gone wrong. The form is 8606, and it exists to track what the Internal Revenue Service calls IRA basis, the portion of an IRA balance that was funded with money on which income tax has already been paid. Here is the structure of the problem. Most traditional IRA contributions are tax deductible. You contribute in a given year, that contribution reduces your taxable income for that year, and when you take distributions in retirement, you pay income tax on the full amount coming out. The transaction is clean, and its logic is straightforward. But there is another category of IRA contribution, non-deductible contributions, made by taxpayers whose household income in certain years exceeded the deductibility limits, but who still wish to contribute to their IRA for the benefit of tax-deferred growth. These contributors put after-tax dollars into the account. They had already paid income tax on that money. When they eventually take distributions in retirement, that portion, and only that portion, should not be taxed again. The law is clear on this. Double taxation of the same dollars is not what the system intends. The problem is documentation. Form 8606 is the instrument that creates the paper trail establishing IRA basis with the IRS. It is filed with the annual tax return in any year a non-deductible contribution is made, and its purpose is to put the government on notice. This money was already taxed. Do not tax it again. If the form was not filed, and for many people it was not, either because their preparer at the time did not raise it or because they simply did not know it was required, the IRS has no record of the basis. The IRA custodian, for its part, reports every distribution as fully taxable income because from the custodian's operational perspective, all of it is pre-tax money. There is no flag in the system distinguishing the after-tax contributions from the pre-tax ones because the form that would have created that flag was never filed. The financial consequence is direct and measurable. A person who made non-deductible contributions totaling $30,000 or $40,000 over their working years without consistently filing Form 8606 may, upon taking retirement distributions, pay federal income tax on money that was already taxed at the time of contribution. At a 22% federal marginal rate, $40,000 of improperly documented IRA basis represents nearly $9,000 in taxes paid on income that was never owed. For many people, this is not ancient history. The contributions were made during specific years when their income was above the deductibility threshold. The consequences are arriving now, in retirement, when distributions are being taken. Two things are essential to understand about the available remedies. First, for past non-deductible contributions that went undocumented, there may be a mechanism to file amended returns for prior years to establish the basis retroactively, a process that requires a qualified tax professional, and that should not be attempted without one, but that the option exists is worth knowing. Second, Form 8606 is critically important for anyone who has executed or is considering a backdoor Roth conversion, a strategy in which after-tax IRA contributions are converted to a Roth account. Without Form 8606, establishing that the original contribution was non-deductible, the conversion appears fully taxable. You pay tax twice on the same money, not because the law requires it, but because the documentation was never created. If there is any history in your financial past of IRA contributions made in years when your income exceeded the deductibility limits, this is a conversation to initiate with your CPA before the end of the current filing season. The conversation takes minutes. The failure to have it can cost thousands, and that is the connective tissue running through every form on this list. The cost of not knowing is recurring. It accumulates. The withholding that runs 30% above your actual obligation does so every month until you file the correction. The Medicare surcharge we are about to discuss does so every billing cycle until you appeal it. The basis that goes undocumented costs you money on every dollar of distribution it affects. The calendar does not wait. The corrections are available, but they are available only to those who know to ask for them. Drop a comment below. Tell us which of these forms you had no idea existed. The answer you leave might be the one that helps someone else finally walk through a door that has had their name on it for years. There exists, embedded in the Medicare billing apparatus, a mechanism that is technically rational, administratively defensible, and in practice, profoundly unfair to a specific category of people. Retired Americans whose income dropped sharply in the year they stopped working, but who are being billed based on income figures from before that transition occurred. The mechanism is called IRMAA. It stands for Income-Related Monthly Adjustment Amount, and for the people it affects who do not know the correction exists, it represents a monthly tax on a financial reality that no longer describes them. The structure of Medicare Part B premiums works as follows. The standard monthly premium for 2026 stands at $185. For beneficiaries whose income falls below certain thresholds, that is the figure. But for those whose modified adjusted gross income exceeds specific levels, Medicare charges more, sometimes substantially more, through the IRMAA surcharge applied to both Part B and Part D premiums. For single filers in 2026, the surcharge begins when income exceeds $106,000. At the first tier, it adds $74 per month to the standard premium. At higher income tiers, the additional charge can reach $443 per month, per person. For married couples filing jointly, the thresholds are higher, but the surcharge applies to each spouse individually, meaning a couple in upper tiers may face combined surcharge costs running into several $1,000s annually. Now here is what makes this mechanism specifically harmful to retirees rather than to high earners generally. Medicare does not look at your current income. It looks at the most recent tax return on file. For 2026 premiums, that means the 2024 tax return. Consider what 2024 looked like for someone who retired in the fall of that year. They worked for 8 or 9 months. Their income during those months was elevated. It reflected a working salary, not a retirement income. Then they retired. Their financial life changed fundamentally. Their 2024 modified adjusted gross income, however, reflects the months they were working, because those were the months captured on the return. And Medicare, looking at that return in 2026, sees a high-income individual and applies the surcharge accordingly. The person now living on Social Security and a modest pension, with a combined annual income of perhaps $50,000, is paying an IRMAA surcharge calibrated to income they earned 2 years ago and will never earn again. The income no longer exists. The financial situation it described ended when the person retired. But the premium surcharge, calculated from a data point that is 2 years old and wholly unrepresentative of the individual's current circumstances, persists, month after month, billing cycle after billing cycle, until someone files the instrument designed to correct it. That instrument is Form SSA-44. It is a life-changing event appeal, available at no cost at ssa.gov. It allows a Medicare beneficiary to request that the Social Security Administration, which handles Medicare premium billing, use current projected income, rather than the 2-year-old tax return figure when calculating the IRMAA surcharge. There are 8 qualifying life-changing events that make a beneficiary eligible to file it: marriage, divorce, death of a spouse, work stoppage, reduction in work hours or income, loss of income, producing property, loss of pension income, and receipt of a one-time settlement payment in a prior year that artificially inflated the income figure on record. For most retirees navigating this problem, the qualifying event is the 4th one: work stoppage. Retirement. That is the event. Nothing more complex than that is required. The financial stakes in specific cases are considerable. Consider a couple, both 67, who retired in mid-2024. During the months they worked that year, their combined income placed them in IRMAA surcharge tiers. The husband's 2024 income put him in the 2nd tier, adding over $259 per month to his Part B premium. The wife's income placed her in the 1st tier, adding $74 per month to hers. Together, they were paying more than $330 in combined monthly IRMAA surcharges on top of their standard premiums. Their actual 2026 income, Social Security for both of them, plus a small pension, was approximately $52,000 combined. They were paying premiums sized for a financial profile they had not occupied in nearly 2 years. Each of them filed Form SSA-44, checking the work stoppage box and documenting their current projected income. The Social Security Administration reviewed the appeals. Both premiums were corrected to the standard rate. Their combined monthly savings exceeded $330. Over the course of the year, including recovery of surcharges paid earlier in the year before the appeals were processed, their total combined savings exceeded $5,000, one form each, free, available at ssa.gov, approximately 20 minutes to complete, no attorney, no accountant, no specialized knowledge beyond knowing the form existed and qualified them. Form SSA-44 can be submitted through a My Social Security account at ssa.gov, mailed to the local Social Security office, or delivered in person. The SSA can also be reached at 1-800-772-1213 for assistance navigating the process. Once approved, corrections typically take effect within 1 to 2 billing cycles. Step back now from the specific mechanics of each of these 5 forms and consider what they share. Form W-4P, which corrects pension and IRA withholding. Form W-4V, which manages Social Security withholding in both directions. Form 1040-SR, which routes senior taxpayers to the return designed for their income profile. Form 8606, which documents IRA basis and prevents double taxation of non-deductible contributions. Form SSA-44, which appeals an IRMAA surcharge based on a life-changing event. Every one of them is reactive. Not one of them is filed automatically on the citizen's behalf. The pension administrator does not review your withholding rate against your current tax situation and adjust it accordingly. The IRA custodian does not flag undocumented basis. Medicare does not alert you when the income year it used to calculate your surcharge has become obsolete. The system is designed to hold the money until the individual files the form that releases it, and the individual can only file the form they know about. This is the honest answer to the question of why so many Americans born before 1971, people who worked for decades, paid into every system that asked them to, honored every obligation, walk away from money that is legally and entirely theirs. Not because the forms are inaccessible, not because the eligibility is obscure, but because no one, at the moment when it mattered, sat down with them and said, "Here is the door, here is your name on it, here is how you knock." If you have a parent who retired in the last 2 years and you suspect their Medicare premium is being calculated on income that no longer reflects their life, Form SSA-44 at ssa.gov is where to start. If your April refund has consistently been larger than you expected, Form W-4P at irs.gov is the instrument of correction. If your Social Security is withheld at a rate you elected years ago under different financial circumstances, Form W-4V at ssa.gov is the form you file to change it. If there is any history of non-deductible IRA contributions in your past, Form 8606 is the conversation to initiate with your CPA before this filing season closes. And before you sign your next tax return, ask the person who prepared it one question. Is this filed on Form 1040-SR? The doors are there. The names are legible from the sidewalk. The money behind them is not a benefit, not a grant, not a program that requires qualification beyond what you have already done by working and contributing and retiring. It is yours. In the most literal possible sense, it is yours. And now you know how to ask for it back. And remember, this is for education and discussion only, not personal financial advice. Tax laws are subject to change. The information presented reflects publicly available guidance for the 2026 tax year. Always consult a licensed CPA, enrolled agent, or qualified tax professional for advice specific to your individual situation before taking any action.